Like I was saying, it's FTX. It's a safe and easy way to get into crypto.
I don't think so. And I'm never wrong about this stuff. Never.
It's been a tough time for crypto since the FTX blowout. The disaster has reignited the debate about the reliability and security of crypto exchanges, and has many people questioning whether using them is worth the risk. In this video, we will delve deeper into this crisis and explore the future of the major crypto exchanges. Welcome to Unpopular Opinion. It's no secret that crypto can be volatile, and the recent events have only added to the uncertainty. Exchange reserves of Bitcoin, Ether, and some other stable coins have fallen sharply as users continue to pull their funds despite attempts by exchanges to reassure them. So how bad can it get for crypto markets? Is there a light at the end of this economic dark tunnel? And which one of these giant crypto exchanges can survive these bad times? One of the main issues is that many of the so-called proof of reserves published by exchanges have left out liabilities and have not been vetted by outside auditors. This lack of transparency is causing concern among investors who are unsure if their assets are safe. Here is where it all started. As we previously mentioned, FTX and its sister company, cryptocurrency hedge fund Alameda Research, operated out of the Bahamas with zero oversight. This lack of regulation ultimately led to the disappearance of at least $8 billion in customer funds, causing investors to rethink the future of finance and politicians to call for tighter controls on the crypto space. The exchange went bankrupt in November. FTX also overextended itself by making significant investments in a variety of cryptocurrency businesses and properties. The company also operated as a hedge fund, which was complex and a risky business model. Also, the former CEO of FTX, Sam Bankman-Fried, is facing criminal charges in connection with the bankruptcy of the company. He is accused of using FTX customer deposits to support his hedge fund, Alameda Research, buy real estate assets for his parents, and make political contributions directly from customers' money. It's not yet clear how these charges will impact the ongoing investigation into FTX and its financial practices, or what the outcome of the case may be. As for the future of FTX, it's not clear what will happen to the company. It's possible that it could be restructured or sold, or that it may go through bankruptcy proceedings. I will stay away from speculating on the specific path that FTX may take and focus more on how has the FTX issue affected other exchanges. Binance. In the wake of the FTX collapse, Binance has been trying to establish itself as a trusted, reliable player in the crypto world. They've even hired Portuguese soccer superstar Cristiano Ronaldo to star in their advertisements because if there's one thing the crypto world needs, it's more sports marketing. Also, they released a snapshot of their major token holdings and promised to share more data in a full, audited report soon. They also published proof that they have the assets they claim to have, to reassure people that they're not just blowing smoke. Unfortunately, the proof Binance offered didn't include any information about how these assets matched up with the exchange's debts and other liabilities, which has left some people feeling a bit skeptical. Binance has also been working on its regulatory compliance and financial stability by partnering with a regulated exchange in Japan and hiring American executives for their US subsidiary. As Binance is working so hard to make you think they're the big superhero crypto market needs, I can share a few reasons why they might probably not be. Let's talk about some of the accusations Binance has faced in the past. First off, Binance has been sued for mishandling sensitive personal data and violating securities laws. Ouch! That's not a good look for an exchange trying to establish itself as a trusted player in the industry. But it doesn't stop there. Binance is also under investigation by the Department of Justice and US regulators as part of a probe into the crypto industry's adherence to global anti-money laundering laws. Yikes. So while Binance has been trying to boost its legitimacy by partnering with a regulated exchange in Japan and hiring American executives for its US subsidiary, it's clear that the exchange has some work to do to shake off its questionable reputation. In a recent incident, there were large outflows or withdrawals from Binance, with customers cashing out around $3.6 billion worth of assets over 7 days. A few days after that, the outflows from Binance had reportedly begun tapering, and concerns about its financial health had quieted down. Whether this was a sign of Binance being completely healthy or not, it's up to you to decide. But if I were you, then I would probably not put all of my money in their hands today. Now let's give more attention to well-deserved and fast-growing exchange, Kraken. Well, Kraken wants you to know that they had nothing to do with FTX's wrongdoings and are still a trustworthy exchange. They went even as far as to freeze verified accounts belonging to FTX, Alameda Research, and their executives to protect creditors. They also tried to assure customers that they have full reserves and that other Kraken clients aren't affected. Now, Kraken may have had to lay off a significant portion of its workforce due to the market downturn, but that's probably just a coincidence and not because of the FTX mess. I mean, just look at their history. Kraken has been around since 2011 and has a reputation for being a secure platform for buying and selling cryptocurrencies with a focus on customer service. Plus, they've never been hacked and are compliant with regulations, at least at the time of me making this video. They even have a digital collectibles marketplace and offer futures and options trading. But wait, there's more. Both Kraken and FTX were clients of Armanino, an accounting and consulting firm. They did proof of reserves audits for Kraken earlier this year, covering a variety of assets. But now, it looks like Armanino is getting out of the crypto game and dropping its clients. Maybe they're just trying to avoid any more class action lawsuits like the one filed by an FTX customer who lost $20,000. So, will Kraken be around long enough? Well, it looks like they've got a pretty good track record so far. Just be careful out there and do your own research before entrusting your assets to any exchange. Last but not least, my favorite, Coinbase. Have you been wondering how the recent FTX bankruptcy has affected Coinbase? The collapse of FTX has reportedly had an indirect impact on Coinbase's bond and equity prices, with the company's bonds maturing in 2028 falling in price by about 10%, and its Nasdaq-listed shares falling by about 20% over the past month. But it seems Coinbase's direct exposure to FTX was relatively small, with the company stating that it only had $15 million on deposit with the Bahamas-based exchange. However, that doesn't mean that the FTX drama hasn't had an impact on Coinbase. Both Coinbase's bond and equity prices have taken a hit in the wake of the FTX collapse. Yeah, the FTX single-handedly took down billions of dollars from the market, including other major players. Coinbase has also assured customers that it is in a strong position and has no meaningful exposure to recent events. To further instill confidence in their platform, Coinbase executives have been emphasizing the importance of transparency and conducting thorough proof of reserves audits to establish financial stability and solvency. In addition, Coinbase CEO Brian Armstrong has tweeted that his company does not lend customer funds and has linked to a blog post from June that explains Coinbase's commitment to holding customer assets one-to-one. And you know what? It's better to be really that way in order to keep other people's confidence in crypto in 2023. Now, you may be wondering if you can trust Coinbase with your money. Well, one thing that sets Coinbase apart from many other exchanges is its transparency and being listed on the US stock market. As a publicly traded company, Coinbase is required to disclose certain financial information to the public, including information about its assets and liabilities. This makes it easier for investors and the general public to get a sense of the company's financial health and track its performance over time. In contrast, many other cryptocurrency exchanges are privately held, which means they aren't required to disclose this type of financial information. So while it can be more difficult to get a sense of the financial health and stability of these exchanges, Coinbase's transparency may give you a bit more peace of mind. So there you have it. Every single one of them, Binance, Coinbase, and Kraken's financial situation, have worsened, and they've been affected by the FTX bankruptcy and recent large outflows. I have a feeling that these exchanges might continue to struggle in 2023 and 2024. And if you are that person who appreciates unpopular opinions, check out my new video right now.